Thank you, Mr. Nath, and thank you, Mr. Bhagade, I think, for summing up the budget so well. I think it makes the work easier for the Rödl Partner team now, who will be coming on board to speak. We'd like to welcome the speakers from Rödl Partner. We have with us Mr. Anand Ketan, Partner Head Indirect Tax Services for the West and South India. He will give insights on the GST and custom-related aspects. Mr. 𝐁𝐮𝐞 𝐁𝐮𝐝𝐲, the Associate Partner, Head Direct and International Tax for West and South India, shall address on the direct tax and international taxation related aspects. And finally, the last speaker would be Mr. Soumitra Dore, who's the Senior Associate and Team Lead for the Corporate and NMA, for the M&A, and who will speak on the regulatory aspects. Thank you for joining us, and we eagerly await to hear and learn from you on how you unfold the budget story for us. Over to you, Anand and team.
Thanks, Jamie. I would request you to kindly, start with the presentation. Directly go to slide 4. Okay. In the time, the slides reach a very, very good morning. I think we still have 10 minutes, so I can still say good morning. Very good morning to all of you from Rödl Partner. A very warm welcome and thanks a lot for the overwhelming response that we've received. This is an annual exercise where all of us meet at least virtually since last 2.5 years. Hopefully, physical meetings would start very soon. This session was planned in a physical way, but unfortunately, because of the Omicron wave, it had to be again pushed back into an online mode. But the budget, this annual exercise by the union government, this really, as Rajesh also mentioned, this is really, every company really looks forward to this budget in terms of, big bang reforms and what else can happen. And the finance minister has has a history of speaking a lot. I mean, in the past, her speeches have been, 2.5 hours or 2 hours, like we mentioned, but this year it was very concise, finished in 90 minutes. And when you even look at her speech, the use of the word like digital or infrastructure, these were used more as compared to the use of word tax. So that really showcases where the priorities of the government lie. Rohit has very, very nicely covered the economic aspects of the union budget, where he has spoken about important policy reforms like digital rupee or battery swapping policy or the crypto tax, so on and so forth. So we will be not taking them in detail. We will be running through these slides. So can you just move on to the next slide, please?
Also,
yeah. So these points have already been covered by Rohit. So I'll just touch upon a couple of additional points here. For example, Forex Reserves. This is another important parameter that is normally looked at. India's Forex Reserves are at all-time high, $634 billion US, which is almost equivalent or higher than our country's external debt. So we are sitting very good in terms of our Forex Reserves. This budget came in, on the backdrop of a very good vaccination program, the world's largest vaccination program, where 93% of the adult population has already received the first dose, and we are on targets to, fully vaccinate our entire population. From a markets perspective, also this was one of the, I would say a mega year where 8.89 billion rupees were raised by 75 IPOs, and the flow has not yet stopped. And we have the upcoming IPOs of public sector units as well as private companies which are lined up in the next few months. Obviously, inflation is somewhere a concern for the Indian government, where the CPI inflation is hovering above 5%, basically on the backdrop of rise in the fuel prices and primary commodities. This is where the government is actually focusing quite a lot, because when they pumped up capital and funding in the Indian economy, the parity has obviously increased in terms of buying capacities of individuals. Even for companies, this has been a bonanza year, where revenues have increased and expenses have reduced. So this is really leading to a slight increase in the inflation levels, but it has to be really seen how this is tackled by the Reserve Bank of India. Some disappointment obviously was there on account of salaried taxpayers or individual taxpayers, where no announcements were made. The finance minister as well as the government, they basically had also done a lot of meetings with the trade and industry chambers, and a lot of representations were made that you should increase the ATC limits, or you should increase the allowance for interest on housing loans, etc. Obviously these announcements were not made, but I think as Rohit also mentioned, fiscal deficit was one of the main concerns, where it is already around 6.9%, and for the next year it is projected at 6.4%. So not increasing taxes is good enough. I would say we have to be happy with what we have, and I think this coupled with the LIC IPO not happening, government having 1,75,000 crores worth of disinvestment target for the last year, which was revised to 75,000 crores for this year. I think this really shows where the money was not corrected. So I think they did not have room to actually make more changes in the income tax law, while they made a lot of other changes, which we will cover in the next slides. Next slide, please. Okay, so when we look at other items, she spoke about Amritkal, 25-year long lead up to India at 100. A lot of announcements were made under PM Gati Shakti in terms of infrastructure, inclusive development. Then obviously there was items on sunrise sectors, where they highlighted artificial intelligence and renewable energy, design-led manufacturing to be really items where the government will be focusing. And a lot of announcements which have already been mentioned were announced in this aspect. Few of them we will be taking in the following slides. Next slide. Okay, so again, this is just a snapshot. This is basically business for all of us. Infrastructure, roads, highways, airports, ports, all of this will be developed. 25,000 kilometers of national highways already spoken about. In terms of train connectivities, new engines, digital health ecosystem, education. They talked about launching TV channels for education, virtual labs, digital university at the GIFT City. All of these, are announcements in terms of where they want to focus more on infrastructure development and creating demand and jobs for the Indian economy. Next slide. Okay. Other important announcements in the next slide that we have is on the digital rupee. This is something which is really has to be focused upon, as Rohit also mentioned. This would really be a new ecosystem wherein India wants to compete with the existing private cryptocurrencies and launch its own digital currency based on blockchain technology. How this will really pan out, whether it will happen in this year or not, what will happen to existing cryptocurrencies? This is at least from a regulatory point of view, because we know that there was a law which was proposed to be introduced in the parliament, controlling and regulating the cryptocurrencies, which was not done. Most probably it will be done this year. But with this announcement, there is a lot of discussion around whether now they have allowed cryptocurrencies to be traded in India. That this is all speculation. At least they have brought in taxation, which Chetan will cover later on. But currently everything is just speculation in terms of regulatory aspects of cryptocurrency. Other items, on circular economy, defense spending obviously has increased, but then they are promoting more startups, and they want to earmark separate funds for Indian defense manufacturing companies. These are all announcements to promote Make in India. Next slide. Next slide. Good. So now we move to the indirect tax related announcements. There was only what finance minister basically said on GST was about GST collections. They mentioned that India had collected 1,40,000 crores of GST for the month of January, which is the highest ever GST collections ever since introduction of GST. And this is going in the same path. Every month now, with the increase in demand, we see that GST collection would keep on increasing. Based on that, the government has also increase the target for collections for the next year, which is around 7,80,000 crores of GST, which they believe they will be able to collect it. Some people feel that this is slightly on the lower side. We can really government can achieve more. But then I think prudence has been the rule that the government has followed for this year. They don't want to exaggerate in terms of their spending or their collections. Next slide. Okay, so now we come to core amendments in the GST law. Just a word of caution, these are proposed these changes are proposed in the central GST legislation. These would be made effective only after the bill received the presidential action. What we have seen is generally it takes around 1 year for the government to make effective all the changes because the relevant changes have to be carried out by the state governments in the local state GST regulations. So these changes may get effected almost after 10 to 12 months. The announcements in the last budget were mostly made effective on 1st of January this year. So, but anyway, when we look at the major changes, first thing was that when the GST law was introduced, there were a lot of sections for matching of the ITC, which the assessees can take, and there was a whole different return filing system. So we had a GSTR 1, GSTR 2, and GSTR 3. Was the return which was supposed to be filed by all persons for their purchases, and then there was supposed to be an online matching system which never took off. Those sections were still part of the GST legislation all these years. Now there's an attempt to sort of clean the GST Act based on the current return filing system. So these sections 42, 43, and there will be changes in 37, 38. These sections have been changed to make effective the current return filing system of GSTR 1, communication of ITC as an auto-generated form in GSTR 2B, and then the final GSTR 3B return for payment. So all these consequential changes have been made. Because of this, Section 50, subsection 3 of the GST Act has been again amended retrospectively. I mean, this section, this is I think the second or the third retrospective amendment in this section. Last year we saw the amendment where they said that if the input tax credit or any liability for, as a matter of fact, it is not availed and utilized. So if it is incorrectly availed and utilized, only then interest will become applicable. This change was made. Now under 50 subsection 3 there was an anomaly because for this mismatch utilize the input tax credit. This has been changed retrospectively, and interest has been made applicable at 18%. So now if you make incorrect payments or avail incorrect ITC, interest would be 18%. Next slide. Okay, so this is a very important change now that the concept of this provisional claim of input tax credit that you can take in GSTR 3B has been abolished. So now what will happen as a system is that every month the GSTR would communicate the ITC available to you, and the credit that you can take would be only to an extent of the amount which is appearing in this GSTR 2B. And this form is proposed to be amended again, wherein they would clearly specify what credits would be available to you and what credits would not be available. So there could be reasons why your supplier has not paid the tax, or he has paid the tax using electronic credit ledger while he should have paid it using electronic cash liability. So the form would basically prescribe what credits would be available to you and what credits would not be available. And you can only take credits which are appearing in form 2B, which is entitled to you. And the whole concept of taking credit based on your own estimation is now gone. There are some consequential changes in other sections because of this, which we are not covering here. The provisions related to cancellation of GST registration for composition taxpayers and for non-composite taxpayers have been changed, and only the time limit has been changed currently. For GST refund, what they have done is now you are allowed to claim a refund of any amount which is lying in your electronic cash ledger, and it has been de-linked with the process of filing of returns. So basically, you can clearly just fill a form and claim a refund of any amount which is lying in your cash ledger. Next slide. Okay, this first change on the left-hand side is a very important change for everyone. Earlier in the GST law, there was a system wherein you can only take input tax credit up to the due date of filing of return for the next financial year. So if you forget to take input tax credit, say for example for financial year 21-22, you are allowed to take that credit before due date of filing the return for the month of September for the year 22-23. Similarly, on credit notes, you are allowed to raise credit notes for the previous financial year up to the due date of filing the return of the month of September for the subsequent financial year. These due dates have been changed, and now 30th November has been prescribed as the date wherein you can take the credits or you can raise your credit. This is a, I would say, an SSC friendly change. Secondly, what they have done is now you can actually transfer the amount which are lying in your electronic cash ledger intra-head. So in case you have paid cash under IGST, now you can transfer it to CGST. Or in case you have paid tax in one branch of your location, you can transfer that cash balance to the other branch of the same legal entity. So this process will be now made effective, and you will be allowed to transfer the cash balances from one branch to the other branch or one head to the other head. Next slide. Other smaller changes, due date for NRTPs has been changed from 20th to 13th. Late fees has been applied for delay of filing TCS returns, and there are some changes which are made again retrospectively, which is for waste generated and for grant of alcoholic liquor license. These have been now exempted retrospectively from 1st of July 2017. Next slide. Okay, I may be rushing a little bit, but unfortunately we don't have a choice because we have too many things to cover. I think so. Direct Tax team also has a lot of changes to be updated. But in case you have any questions, you can certainly raise them, and this PPT would also be shared with you, so you can go through everything. So I'll move on to the changes under the Customs Act. Customs regulations have been ongoing significant change. This is where they are focusing. Mostly, the idea of the government is to use the customs legislation to increase the manufacturing facilities in India. So they want to promote manufacturing in India, and they're using the customs law as a tool to achieve that objective. And again, this year and also in the last few years, we saw that most of the changes that were done were based on this idea. So when we look at the major changes, what happened this year? First is that the customs tariff has gone a significant change. So if you are importing goods in India, this is something that you have to really focus upon, because what had happened was over the years the government used notifications as the effective means to communicate the rate of customs duty that is applicable on your products. So essentially you have the rate which is prescribed in customs tariff, and then you have the notification which prescribe the effective rate of customs duty. This created a big issue because you had these exemption notifications which are huge. They run into hundreds of pages, and then it just simply creates confusion. So what they have done is they have moved the entries from these exemption notifications which were unconditional, and these have been transferred to the tariff, the customs tariff, and the government says that we want to now regulate the rates of the customs duty from the tariff, not from the notification. So a lot of these entries have been transferred from the 50 of 2017 notification back to the customs tariff. Secondly, they have again made a lot of changes in terms of items or products which enjoyed exemptions under the customs regulation. For example, entry 4 of or list 4 of entry 1 which prescribe exemptions to chapter 38 on life-saving drugs, medicines, and diagnostic kits. Around 40 items have been removed from that list. So this again will have an impact on the medical sector, where government says that you can really manufacture these items in India, and therefore we don't want to promote exemption on the import side. Also, very importantly, they have given lists of items where the basic customs duty exemption or concessional rate would be done away with on 1st of April 2023 and 2024. So they want to really tell that we want to have a stable policy, and we want to show that what changes are going to be made, they're already available to you. So it's a very long list of items where the exemptions will be done away with in the next and the subsequent years. Lastly, very important change in terms of capital goods. So we had two schemes. One was the project imports, wherein you can import your entire factory, show it as a project import, and under chapter 98. And this project used to enjoy lower customs duty. Also, a lot of capital goods falling under Chapter 84 of Customs Tariff, they were enjoying exemptions or lower customs duty of 2.5%, 5%, etc. So all of these materials and goods, they are now proposing in a phased manner that the lower customs duties would now be changed and a peak rate of 7.5% will be achieved on all capital goods which are under Chapter 84. Next, they have now introduced a phased manufacturing program. This phased manufacturing program is currently for 3 items, which is smartwatches, hearable devices, and electrical meters. This earlier was done through licensing means. Now government is saying that we want to promote manufacturing in India through an exemption route. That means if you import the finished goods in India, you will end up paying 20% or 15% basic custom duty. While if you import raw material and absolute CKD parts, you will get nil customs duty. So they want you to manufacture these goods in India, and there is a high possibility that more and more goods would be brought under this umbrella of phased manufacturing program. Some basic customs duty rates have been reduced on textiles, uncut diamonds, and anti-dumping on steel has been removed because the steel prices have shot in India, and therefore they want to really compensate by reducing the anti-dumping duty on steel so that the prices can go down a little bit. Next slide. So this list has items where the rate changes have happened. There are a lot of items where tariff rates have been increased, like plastics, glass, electric motors, measuring equipment. So all these rates have been increased. It's a very long list, hundreds and thousands of items where rate changes have happened. So I'm not covering them in detail. Next slide. Okay, so now a few important legal changes under the Customs Act. There was a huge debate which happened after the Supreme Court case in case of Canon India, where the Supreme Court said that the DRI officers are not proper officers for adjudicating matters under the Customs Act, which meant that if a DRI officer has issued a show cause notice to you, that show cause notice is void because DRI officer was not the proper officer to adjudicate the matters. This created a big issue because DRI officers and DGCI officers and SIIB officers, they on a routine basis kept on issuing notices. And basically after this, a lot of further judgments also came up where high courts and tribunals also said that these notices cannot be proceeded with because they were issued by DRI officers. A retrospective change was expected and it has happened now in the budget. Now government has basically said that DRI officers or SCA officers or audit wing officers, they are proper officers and they are allowed to issue notices to the assessees and carry out adjudication. The notices which have been issued prior to the amendment, that action by the officers has also been validated, and it has this has happened by the finance that the old actions done by the DRI officers would now be valid. So in case you have a pending matter where the notice was issued by DRI, now that stands to be validated. You cannot use the ground that DRI officer was not the proper officer to give the show cause notice. Advanced rulings, several sections have been changed under advanced rulings. Most important being that now an advanced ruling would be applicable only for a period of 3 years. What will happen after 3 years? No one knows. Whether the customs can actually now come in and issue notice after 3 years, we don't know. This change was basically after the WTO trade facilitation agreement which India signed, but this has created more problems, and we see it more as a step which is not good for the assessee because this will make advanced rulings a bit less attractive. People would not like to go for advanced rulings because they are applicable only for 3 years. Then there's a section which is a proviso which is inserted in section 14(1) relating to valuation of goods. So where what used to happen was there were specific goods like metal scrap, etc., where there was very difficult to ascertain the valuation of that particular goods, and the government used to use LME and other public sources to undertake valuation. Now the government has been empowered that importer would be required to carry out additional obligations when they import such items. Next slide. very important change has been carried out in the IGCR rules. This IGCR rules are basically where you are importing goods on concessional rate in India, and you are required to follow the procedures prescribed in the IGCR rules. The change basically is that now the entire system has been made online. So before importing goods where you want to really claim a concessional rate, you have to file an online form and get an IIN number. This is an identification number which has to be then mentioned in your bill of entries, and then the concessional rate would be allowed to you. You would also be required to file a monthly return on the online portal, and all these systems would be now brought in very quickly, because this amendment is effective from 2nd of February. So everything has been given a digital push now. The manual filings will go away. Online application and online filings in case you're importing goods on concession basis. Social welfare surcharge, there was a circular which has been issued now to do away with the litigation on this aspect. The issue was that the customs authorities were saying where the basic customs duty is nil, you still have to pay social welfare surcharge on a notional basic customs duty if that is not exempted. That was certainly not the intent of the legislation, and a lot of litigation happened on this aspect. So now the government has brought a circular, and they have said that if your basic customs duty is nil, then the social welfare surcharge would also be nil, and it cannot be calculated on the notional value of basic customs duty. Section 135AA, it's a very interesting section which has been inserted in the Customs Act. You might be aware there were websites like 𝐓𝐡𝐞 and 𝐁𝐮𝐝𝐚𝐫𝐢𝐝𝐚 websites which used to give you information on the imports which are undertaken in India. And these databases used to give that information based on customs CTH numbers, the port from where you import, bill of entry, the valuation, classification. All of this information, if you just pay a few bucks, you can actually get this entire information from these websites. There were a lot of complaints which specifically had made that our data is publicly available on these platforms. Many times you have products wherein the company name is mentioned in the description of the product. So your competitors would actually see the rate at which you are importing your goods into India. So based on these complaints, now the government has made publication of this information, whether online or in physical form, it has been made an offense. So no one can now publish such information without permission of the central government. And if you make such publications or you publish such information, you straight away have a prosecution provision which will be applicable. So these websites, the business of these websites are going to go away. Next slide. Yes, so lastly, I'll close indirect tax related points by saying a couple of points on the PLI scheme. There was an additional allocation to the solar PLI. So solar PLI was, I would say, one of the most short PLI schemes which was introduced last year, where there was a high focus only on photovoltaic cells, very, very specific cells which they wanted to promote. There was a very, very high interest in the industry because of the renewable energy push of the Indian government. So now they have made an additional allocation to the solar PLI, and whether they will make it more wide and cover additional solar products, it has to be seen. Lastly, there is a lot being said about the SEZ Act. We all know that SEZ Act was plagued with a lot of issues because a lot of land was lying vacant. After the income tax exemption went away, people said that it is not more effective, or it is the utility of SEZ has actually gone away. So now what they are doing is they are doing away with the existing SEZ Act and they want to bring in a new act altogether. As said earlier, we don't know what would be the main structure of the act, but some points are very clear that they would certainly allow more DTA clearances. They would allow, make SEZ as a multi-product SEZ and not specifically for a specific product, which used to be earlier. And the compliance requirements would certainly be narrowed down. They have already announced that the SEZ Act would be completely governed online with the customs portal. So in terms of the coverage would be enhanced significantly. They want to include special enclaves into the SEZ Act and certainly make it more IT driven. So how it will basically come up, we don't know. But this is a very important year for exporters because a new SEZ Act and a new foreign trade policy. We know that the foreign trade policy, the old one, is being extended by 1 year every time. So again, March 2022 it is due to get renewed. So the new foreign trade policy and the new SEZ Act, this will be a complete game changer for the exporters in India. So with this, I complete the updates on the indirect tax side. I think I've just used a bit more of the time which is allocated to me. So I now give the mic to 𝐁𝐮, who will now discuss the direct tax changes.
Thanks, Anand, for summarizing indirect tax changes. So I'll take you through direct tax proposals. Can we move to the next slide? Yes. So everybody knows no changes in tax rates, and the question may arise, okay, if there is no change in tax rate, is there really anything to discuss? But let's see what are the changes, some of the important changes we have captured in subsequent slides. So next slide, please. So as you all will be aware, the new manufacturing companies are eligible for a concessional tax rate of 15%. So the timeline to start the manufacturing was set as 31 March 2023. And looking at COVID situation, there may be delays in plans to set up the manufacturing facility. And that's why this date has been extended by 1 more year to 31 March 2024. So now if you set up the new operations manufacturing facility by 2024, that should still be eligible for concessional tax rate. Then for startups also same way, they have extended by 1 more year. So startups are eligible for 100% deduction of their profits for 3 years. So now they have been there was a timeline of 31 March 2022 to start the business, and now it has been extended by 1 more year to 31 March 2023. Next slide, please. Yes. So there have been certain changes which kind of try to reduce some of the tax litigation points. These are both some of the changes which help taxpayers, some of the changes which don't help taxpayers. So first and foremost is deductibility of education cess. So we know, like, when we calculate income tax liability on our income, there is a surcharge and then there is the education cess. So the education cess, since it is not called specifically as income tax or surcharge, then whether really it should be deductible, because we know that income tax is not deductible by way of a specific provision. So what happens about education cess? So there has been a kind of lot of rulings which have held that the education cess should be deductible. So now that has been sought to be nullified with a retrospective effect right from by 2005, 2006 when the cess was introduced. Now this provision specifically clarifies that this amount will not be deductible. So the amount may not be significant for many companies, because if you say 100 crore is the turnover and 10% is profit, so which comes to 10 crore, the likely impact of tax on such cess is going to be less than 5 lakh. So that's how it is not very significant unless until the operations are big and the tax liability is significant. So that was there. Then next is the section 14A related disallowance. Again, this is more relevant when there is an exempt income, say that is earned. So earlier it used to be a dividend income. So dividend used to be exempt in the hands of shareholders. So such income was earned. Then any expense for earning such income was disallowed. So courts had held that if there is no exempt income in any particular year, then there should be no disallowance. So that is also sought to be that anomaly is sought to be removed. And so even if in 1 year you don't have exempt income, but some other year you may have, and that's why whatever expense you incur to earn such income is going to be disallowed, whether in that particular year there is an exempt income or not. Then in case of amalgamation demerger, again some clarity is brought in that there was because amalgamation demergers can take a couple of years to get a final approval, and then there is no timeline to revise the returns. So now they have given a 6-month timeline to revise the returns in such cases. Same way in case of assessments, what happens is that if there is a predecessor who has gone out of existence, then whatever orders may have got passed in his name may become invalid. To protect those orders, they have said that till the time the process is going on, if any orders are passed on predecessor, they will also be valid on the successor of the business. We can move to the next slide. Then there are also some more amendments which seeks to reduce litigation on same lines. So one is the deduction under 37 for business expenditure. It is said that like this is more relevant for pharma company where any kind of freebies etc. are given to medical practitioners, and that is against the guidelines set by the association for such practitioners. Then those expenses were still there was a debate whether it should be deductible or not. So that is sought to be clarified that it will be not deductible. Same way, any expenditure in connection with offense under law is not deductible. So it is clarified that even if it is offense under outside law outside India, that will not be deductible. Then in respect of 43B provisions, which allow certain expenses on payment basis. So in case of any interest that is payable to any financial institution, NBFC, bank, then that is generally deductible only on payment basis. So in case like in case any company is trying to convert this interest in the debentures or any similar kind of instruments, then certain rulings are held that this will be deductible because this is a discharge of interest when you convert it to debenture. So that is thought to be again nullified, these kind of rulings, to say that even if you convert interest into such instruments, still it will not be considered as paid, and that's why deduction should not be allowed. Then another change is in respect of deferral of filing of appeal by department. So we know that there are a lot of issues which are in front of courts and it takes years to get the ruling. Now what happens, till the time you don't get a ruling on such issue, if it is a question of law, then any other taxpayer who is facing similar issue will again have a similar challenge, that there will be multiplicity of appeals by every taxpayer for every year. So to reduce this issue, what is sort of, if there is an identical question of law that is in front of any higher forum, then tax officers will not file the appeal in such cases after taking consent from the taxpayer. So once the issue is finally decided, then all these other matters will also be taken up appropriately. So this should somewhere help to reduce litigation and to reduce the cost that taxpayers incur on repetitive litigation. Then there are certain other clarification, like there was an amendment in goodwill last year, so there is a additional clarity provided on some of the aspects that were missed out. Same way, slum cell definition was changed last year, so there is a consequential amendment that was missed out last year, so that has been again brought in. These two changes have been done with effect from last year. Move to the next. Yes. So now this is a very important change that has been brought this year. That is the updated tax return. So we know there is a normal return you file in timelines. There is a revised return. There is a belated return. Now there is an updated return that has come up. So here it is nothing but the taxpayer gets one more opportunity. If he has missed out to furnish any information, any income for tax, then he can file an updated return. And there is a timeline of 24 months. There are certain conditions that it should not increase the refund, or it should not be a loss return that you will file under this. So the clear idea is that you should be offering something additional, you should be paying some additional taxes, then only this return will work. Of course, if there is an ongoing assessment, there is a search. In such cases, you will not be able to do it, obviously, because otherwise taxpayers may wait if there is a proceeding has started and then they will file the updated return declaring additional income. So that is not the intention. If any proceedings are started, then you can't really go and file this updated return. It is for genuine miss outs. If you miss out something to offer, then better you go and offer it. Again, here there will be additional interest liability, and over and above tax and interest, there will be you have to pay additional amount of 25% or 50% depending on when you file. So if you are filing within 12 months, the updated return, then there is a 25% additional premium that you need to pay. And if it is after 12 months but before 24 months, then it has to be 50% over and above the tax and interest amount that has to be paid. So we can move to the next slide. Yes. So then probably you'll be aware that last year there was a provision introduced that higher rate of TDS or TCS will apply in case the other party whom you are either making a payment or you are receiving a payment from, which are covered for TDS or TCS purposes, and they have not filed return for 2 years, then you needed to withhold taxes at a higher rate than the rates that are specified. So this time limit of 2 years has been reduced to 1 year. So even if a person has not filed the return for 1 year, then this will apply. And in fact, the way the provision is worded, if the timeline is over for filing the return, the normal due date, so in that case also this provision will apply. So if there is a late return getting filed, in that case also for the period between the expiry of due date and late filing of return, whatever period is remaining, even for that period there will be a higher TDS or TCS will apply. So that's why the timely compliance by way of filing return will be essential. Then there is a provision regarding TDS on immovable property. So we know that if you are purchasing an immovable property, then you need to generally withhold the taxes if the amount is more than 50 lakhs. So now what has been done is, so it can be a consideration for that property or a stamp duty value, whichever is higher will have to be considered to decide TDS. So it should not happen that the deal is done at a lower price, but actually the stamp duty is higher. Then in that case, TDS should apply on a higher price. Then a new provision is thought to be introduced regarding TDS on benefits or perquisite provided to any person in the course of business or profession. So this provision is something which I think will have to be looked at carefully. What all types of payments are happening, what kind of benefit or perquisite is passed on by way of such payments, and TDS will have to be done. So this is something which I think will have to be looked at carefully. This is something which has come altogether new and probably may impact many companies. Then there is a change in penalty provision. This again may not be very relevant or very kind of very frequently encountered, but actually the per day penalty of 100 has been increased to 500 for certain kind of offences. Some of the offences that can be correlated is like TDS or TCS certificates or Form 16, such kind of documents. If they are issued late, then there will be a per day penalty of 500, which was earlier only 100. So there is a significant increase. So we can move to the next slide. Yes. So then these provisions to some extent may not be relevant. Like in case of a dividend from a foreign subsidiary, the Indian person was taxable at 15%. So this benefit has been withdrawn. Then there is a refund of tax withheld related amendment. So earlier, if any refund was to be claimed, then there was a provision to directly go and appeal before CIT appeal. So now there is a mechanism provided to appeal it, go before assessing officer and then go to the commissioner. Then there is another important changes regarding section 68, where any kind of credit in the books of accounts, if it is not properly explained, then that may be subject to tax. Now what has been sought to be done is there is a specific provision that has been brought in that in case of loan transactions, when a credit is given to other party, then if the source of income for that party, that is the lender, is not properly explained, then there could be even that amount could be considered for taxation. So this is a very significant change, and when there is any loan etc. being obtained, I think there will be more kind of documentation also need to be seen. What kind of documentation can be kept to overcome such kind of provision? Otherwise, there will be a huge tax implication that may come up. In case of liability of a director of a company, there has been a clarification that this provision only will not apply in case of liquidation, but it will generally apply in all the cases. We can move to the next slide. Tax on virtual digital asset. I think probably some of you may be kind of better placed to know this, who are actually dealing in this kind of transactions. But yeah, like there is a 30% tax introduced. The cost of acquisition will only be allowed, no setup of losses etc. from any other source, or losses of this particular transaction will not be allowed to be set off against anything else. So there is a kind of clear-cut guideline to tax it at 30%, only allow the cost of acquisition. Again, TDS will also apply on such transactions, and even gifting of such digital assets also will be liable to tax. Of course, gifts to relatives can be excluded from this, specified relatives. Yeah, we move to the next slide, please. Specialist proceedings, we know like last year it has been introduced. There have been some challenges in proper implementation. So there was one of the provisions was that if the proper process is not followed, the order will be invalid. But government realized that there are a lot of issues in implementing this, and that's why that provision has been done away with. So the order will not be directly invalid. It is just that probably the procedure is not properly followed. So some kind of remedy can be done for that, but the order itself will not become invalid now. And of course, there is a provision that now mandatorily they will provide an opportunity in case you ask for it to present your case. Earlier there was kind of it was optional. We can move to the next slide. Yes. So in case of reassessment, they have kind of added some more categories, in which case it can be considered that income has escaped assessment. So that has been done. Again, they had curtailed the time limit for reopening the cases from 4 and 6 years to 3 years last time. But at the same time, they had introduced one more category where you can reopen up to 10 years in case there is a kind of some information that is available with tax office which has a more than 50 lakhs of value as escaping assessment. So some more categories have been introduced to it. So it was only in the undeclared asset was there. Now even if you are having some kind of expenditure on entries in books to the extent of 50 lakhs or more, basis which it can be decided that income has escaped assessment, then even in those cases it can be now reopened up to 10 years. So now I think somewhere it has again gone back to the old era where I think it was 4 to 6 years, 4 and 6 years. Now it is 3 and 10 years, and 10 years is generally once the value is more than 50 lakhs, 10 years. So it is actually extension of time period for reassessment cases. Yeah, we can move to the next slide, please. There are some small changes in case of transfer-pricing. So there was commissioner has powers to revise the orders of lower authorities, but for transfer-pricing there was no specific provision, so they have introduced that. Again, faceless scheme for transfer-pricing was there in pipeline, and there was a timeline up to 2022. So for now, TP and DRP processing they have extended it to 2024. So by 2024 they can implement this scheme after considering the experience of faceless proceeding for corporate tax assessment. We can move to the next slide, please. Yeah. So there is some change in case of insurance for dependent disabled persons that is there, and another change is in relation to COVID treatments. So I think for this there was a clarification already brought in. So now this has been brought in by way of a specific provision in the law. So any kind of expenditure. Any kind of expenditure that is incurred for medical treatment or illness related to COVID, and that is somewhere contributed by some other person, then it will not be taxable entirely. At the same time, if there is a person who expires because of COVID and the employer helps, then that amount will be non-taxable without limit. But in case any other person grants any help, then up to 10 lakhs, that amount will be not taxable. Beyond that it will be, and there is a time limit of 12 months to get such kind of help from anybody. So yeah, so that's it from my side, and we are through with the budget proposals on direct tax side. So now I'll pass on to Soumitra for legal updates.
Thank you, Chetan. Thank you everyone for joining us. Regarding the regulatory and policy proposals, I think most of them have already been covered by us. So I will just touch base upon a few of them. So from corporate on labor laws, there has been proposal to amend the insolvency code to have a transparent cross-border insolvency process. So currently, the insolvency code does not have a transparent process for having a cross-border insolvency. So that has been proposed. So the details are not yet out. So we'll have to see that what exactly we will be having in such amendments. The second important announcement was to have a accelerated process for voluntary liquidation of the companies. Currently, the voluntary liquidation takes around 2 to 3 years time. So they want to reduce this time to 6 months. And immediately on the date of budget, that is on 1st February, the insolvency board has already issued a discussion paper and on the revised process for voluntary liquidation of the companies, and that is based on the insolvency board's website, and it is open for comments until 22nd February. So I think they are really taking up a pace here to accelerate this entire process. Also, some of the highlights